Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us for this week's Market Carver edition. Before we move on to the topics for this week, just wanted to send a reminder out there that we are now less than 90 days away from the Schwab and TD Ameritrade merger. We are thankfully internally to Zaria, whom I'm sure many of you have had the pleasure of meeting, who has been our dedicated person to really stay inside and really follow where that's going to be taking place and all the things that are going to impact each parts of our business. And so we've tried to keep in communication with you. We're looking forward to it because it really takes what we have had available at TD Ameritrade and it takes the best of what's at Schwab. I think that we'll have a better combined tool. So we're also not naive and know that there'll be some logistical things. There's always a surprise here and there, but eventually I think we'll all be very glad for that transfer. So looking on to the topics for the week, we do have four things to share. A couple in the housing market. Took a long, deep look at the market, housing market that is, in this week's investment meeting call. And so I'm going to share with you a couple of those highlights, and then Andrew will update us on where we're at with something that's been the theme all year in breadth. And really giving us an update on the stocks and whether or not we're seeing broader participation. So we'll dig right into it in terms of mortgage payments. So we have seen a really rapid adjustment in terms of housing affordability. We really were in a golden era just say 5-10 years ago where housing prices were really still sluggish coming out of the great financial crisis. We had a strong economy and we had low mortgage rates. We really had a really strong combination. But if you take a look at the chart we're going to show up, it has really changed very rapidly because you've had two of those things swing on us. We've had, of course, a rapid increase in interest rates. And not only, and there's an important point on the mortgage payments, it's not just the interest rates, but the spread or the additional interest that is charged to mortgages is as wide as it ever gets. So you add those two things together and the mortgage rates are really up there. And then we've seen housing prices, of course, soar, especially and notably coming right out of the COVID environment. So a good rule of thumb is somewhere 25 to 30% a mortgage payment in terms of a total income is a good rule of thumb for what is normal. You can see the golden era we referenced there in terms of 16, 17, 18, 19%, where mortgage payments were as a percentage of income. But we are now throttling back into much higher territory. And this is going to make it very challenging when there is some turnover in the housing market. But another unique factor in this market, if we go to the next slide, we see that there is no housing supply. So even though we've got this tough dynamic for buyers, given the higher rates and the high prices, however, they really don't have many choices. That's because so many people have mortgages locked in for 30 years that are 3% or even lower. So the hurdle to jump and actually sell the home is very, very high. And so typically what we'll see in this economy is an average of 5 months housing supply. We are all the way down at 2. And if you just think about your own situation, what it would take to get you to give up that 3% mortgage, if you do have one, is a high hurdle. Now, a couple of things will eventually come in and change this. The first is that if you look at forward interest rates or what the market expectations are, that we would see those mortgage rates settle back down. If they were to come back into the 5% range, as an example, it would likely get some of these people who held off or stayed in a home longer than they'd wanted to get out there and actually put the for sale sign up. And the nastier way would be if we saw a change in the labor market. We got news last Friday, that the labor market just continues to be strong. And as long as people are staying in their job and there's a lot of opportunity there, there's not a compulsion to have to sell your home because you're unemployed. So we've got that positive attribute coming. But in reality, so given the headwinds that were expected to come from the housing market, so far it has only helped to underpin the strength in housing prices. So we'll be watching that closely, of course. So that's the housing market side. We'll now pass the ball over to you, Andrew, and give us an update on the technical side of the market.
Thank you, Adam. So, after a conversation we're having almost on a weekly basis when we talk about the stock market is we want to look at how individual stocks performing. This is something we talk a lot about on the market cover as well. And something that a theme throughout the first part of this year has really been the lack of broad participation. And we've started to see less and less stocks are making new highs. Meanwhile, the index itself is making new highs. We saw the S&P 500 close last week at a new 6-month high, edging pretty close to a 52-week high this week. We'll see how we close out on the week, but we aren't seeing a lot of stocks do the same. At the end of last week, we had, when the market was making a 6-month high, less than 4% of stocks were doing the same. We've really seen the market be driven by just a handful of equities, which is not abnormal. We've seen this happen in the market before, and the market can persist for a long period of time on just the backing of a couple stocks, but it makes it a much less healthy environment and more prone to potential pullbacks. Now, we are starting this week. We record as always on Tuesday. This comes to your inboxes on Thursday. We're starting to see a little bit of broadening out here recently. We started seeing small caps once again have started to pick up their performance and having better performance. And actually, when we start looking at broad industries, we are starting to see those start to rise. So the individual stock level, we're not seeing a lot of individual stocks participate, but we are starting to see more industries. So when we think of technology, we think of then the actual individual industries like semiconductors and computer parts. So each sector is broken down into much smaller categories, and that's what we have in the S&P 500, all these different industries. And so on Friday, we really hadn't seen over the last year more than about 12% of industries make 52-week highs. Coming into the downturn last year, we started seeing less and less industries making new highs. You can see on the far right side of the chart on that green portion, we had less industries going higher. And then when the market began to correct and then we started to rebound since October, we want to see an expansion of industries, just like we do with individual stocks. And 12% was kind of the lid that we were seeing on that. We weren't getting above 12. Well, last Friday, we hit 15, a much higher, not a huge increase, but an increase nonetheless, with 15% of industries making 52-week highs. And we're not really seeing a lot make 52-week lows. That's a good sign. So I guess we could say this is one good step in the right direction. We got the market continuing to rally. Industries are improving. Now we really, really want to see individual stocks really start to participate in this market and not rely on just a few mega cap tech names. We'll see going forward if that happens. These are the good ingredients we want to see to be baked into this market. We'll see what it eventually produces in the coming weeks. Hopefully something pretty good and pretty tasty.
Yeah, very well said, and couldn't agree more. And that's where all of our eyes will be, and so many in the industry. So, as always, Andrew, thank you for that update, and thank you to all of you for giving us this time and watching this week's Market Carver. As always, don't forget to give us a call if we may be of service. 800-928-4001. Thanks again, and have a great weekend.